This
all the volatility
conference will
things are at.
now be recorded.
So, anyways, with that, and then I thought that we'd switch gears a little bit, talk a little bit about um, some behavioral challenges, what we refer to as psychology of investing. Just a presentation that we've done in the past that we think is really timely in today's market. If we have time, we'll hit some of those slides. But first off, let's just talk a little bit about all the volatility that we've seen in the marketplace. Other than the virus, obviously, it's been the defining feature of the sell-off here. Um, if you look, we had a stretch 2 weeks ago where the market was down 8 consecutive days. It was either up or down by 4%. And so 8 consecutive days. And you had to go all the way back to November of 1929 to find a stretch where that was even close. It was actually 6 days back in November of 1929 that, yeah, you had the market go up or down 4% in consecutive days. So it had never happened 8 days in a row like we saw a couple of weeks ago. Even as volatile as 2008 was, it wasn't nearly you only had 4 days there, so it wasn't nearly as extreme as what we've experienced here. And obviously, whenever you see volatility in the marketplace, especially to an extreme amount, it's all about the market trying to digest what the impact is to the economy. So this one is very difficult. Obviously, just the virus being such a different and unusual situation that we haven't had to deal with, really a healthcare challenge at the end of the day, and not being able to really get any precision or clarity on what that impact is to the economy. So that's really the challenge of what the market's trying to digest from a volatility standpoint. I think one of the things you see is that these aren't all bad days. You see some of these good days sprinkled in here. And it's one of the challenges we see with folks, even some of the best investors we work with, is it's a natural emotion, right, to have some of these bad days or bad weeks and want to get out of the market. So that's something we try to remind folks that these good and bad days tend to cluster together. Historically, it's not just this period. It happens all the time throughout history. We went back and we looked at the last 20 years prior to this crisis, and there was the worst 25 days in the marketplace. 24 of those 25 days actually were surrounded by or in close proximity to 25 of the best days. So within actually 1 month, you had 24 of the 25 worst days over that 20-year stretch, followed by or surrounded by those 25 best days. So the challenge there, of course, is if you do something with your portfolio, with your investment plan following some of these bad periods, very likely you're going to miss some of the best days on the other side. And that's the challenge that we try to remind folks that, hey, some of the volatility here, it's just so difficult to time. If you move out after a bad stretch, you're probably going to miss one of those good days on the other side, and that certainly does a ton of damage longer term. So certainly the volatility has been one of the defining things. I think one of the things we can do here is lean on history. And we've got a chart here for you. Hopefully I can pull it up here without too many problems. That looks at some of the worst days, worst months, and worst 3-month stretches in the marketplace. And we updated this through the end of the quarter. And the worst days, of course, we picked the top 15 going back to 1950. So really that end of World War II, post-World War II era, 70 plus years of history here. You can see the top 15 days. We've actually had 3 that would have qualified over that 70-year stretch here in the last month. The worst was that March 16th date of 2020. There you can see it was down about 12%. But you can see the other entries there for worst days. The worst day was October 19th, 1987. If you remember that Monday, the market was down 20%, believe it or not, in one day. And you can see some of the other periods as well. You got some other 87s in there, a lot of 2008. You got some 97, 98, 88, even 62 is in here. So good, a good amount of periods across the board represented. And you can see the average day is down about 9%. But if you look back and zoom back the lens to a longer time period, 1 year later, the market's up on average 24%. So that's something certainly we can lean on. They often say history doesn't repeat, but it often rhymes. I think that's a Mark Twainism. And I think we see that a lot with the market. We can do that with months as well. You can see March of 2020 was the fourth worst month over the 70-year stretch. And again, look at those worst months in history. You're up over 20% on average over the next year period. Not every year, every period is positive, but you can see history is overall pretty compelling and on our side when we look at some of these historic periods. And we also looked at 3-month stretches as well. That this is one of the this was the worst first quarter in history, but just losing that calendar year time period, just looking at all 3 months calendar time quarters is somewhat arbitrary. You can see it was about the 9th worst 3-month stretch that we've had in the market. And again, you can see what the market's done a year later on average for these, up over 20+%. So for us, we just think it's nice to lean on history a little bit to better understand how the market reacts following some of these big declines. But I think it's a good point now to really switch gears a little bit and talk about the behavioral challenges. We can lean on history. We can talk about some of the volatility in the marketplace, and they're all important. But I think one of the keys here too is to think about how our emotions affect our investment decisions. So this is that slide popping up for you guys seeing the psychology of investing slide or no?
Yes, that's up, Mark.
A thumbs up. Thank you. Sorry, I missed the thumb. And the psychology of investing is really something that has grown in the industry quite a bit, just looking at how our emotions, how our minds are programmed to think about our investing decisions. So it's called behavioral finance in the industry on the academic side as well. But we entitled this presentation The Psychology of Investing because nobody knows what behavioral finance is. I found presenting this topic, but it's really just that study of how our emotions affect our investing decisions, our financial decisions. And it's gotten a little bit more attention in the press lately. Richard Thaler from the University of Chicago won the Nobel Prize for his work around behavioral finance back in 2017. And if you're familiar with Michael Lewis, the author, who wrote Blindside and Moneyball, my favorite baseball book, one of his most recent books in the last couple of years is called The Undoing Project. And it's about two of these behavioral economists that started a lot of this work 20, 30 years ago to better understand how our minds are programmed, how our emotions impact our investing decisions. So that's the psychology of investing. I thought it might be helpful to give you an example of what we mean. I can talk to it all day, but I think it's more helpful to give you an example of what behavioral finance is. So here's a choice of 4 different lines, and hopefully if you can't see the screen, there's one line that ends up with the best outcome, but it's very volatile. That's the red line. The line that comes in second place is the purple or pinkish line. I still can't tell what that color is, but it ends up in second place, but does so in a very straight line fashion. Then the third is the green line, a little bit more volatility and finishes in third place. And then the yellow line is fourth place and ends up towards the bottom. And the question, and this works better when I'm in front of the live audience here, but I always ask, which line would you choose for your investment going forward? Just knowing only what you see on the screen about the investments. And 90% of the folks in the audience pick that pink or purple line, being the second best outcome from a total return standpoint. But it did so with a lot of just a very predictable, what seemed to be predictable way. You maybe get 5% take the red line. I call those the greedy folks, take the highest outcome even with all the volatility. And you maybe get another 5% that takes the green. I call those folks the contrarians. And nobody ever takes the yellow. The yellow is the lowest outcome by a pretty good margin, so nobody ever goes there. But look what happens to these lines in real life, these are actual investments, believe it or not. Red was Pfizer, an individual stock that did extremely well, but it kind of depended on when you got in. Green came in second, which was the S&P 500 or the U.S. stock market. The yellow was third. Nobody took it, but it was the Treasury bill. Just given low interest rates, didn't look like much of an option there. And pink, of course, that 90% of the folks took. It was the Fairfield Century Fund. Nobody ever knows what that is, but it was actually the Bernie Madoff feeder fund, which of course was too good to be true at that point in time. And this highlights just the reality that we see and what behavioral finance and the psychology of investing is all about. Everyone gravitates towards that pink line because we really are in this tug of war in our brains around risk and reward, right? How much reward are we going to potentially achieve given how much risk we're going to take on? So obviously we're always trying to get as much reward with as little risk as possible, and that's what the pink line looks like it presents, right? It looks very predictable. Actually, it was too good to be true in this case. But this is an example of what behavioral finance is. It's that struggle within our emotions and our minds, trade-off between reward and risk. And one of the key things that we talk about at BlackRock, and I think it is so important that we don't talk about it enough as an industry, is all your emotions really go into affecting your investor behavior. So your investor behavior means, are you going to do the wrong thing at the wrong time, essentially? And these emotions can drive that type of behavior. And this investor behavior is the foundation of any good investment plan. You could work with the best advisor, right? Doug and team could be the best team at building a portfolio in the country, or you could work with the best tax planner, right? You could do taxes better than anybody else. But if your investor behavior gets derailed by your emotions, the whole thing falls apart, right? Because you're not in the market to participate on what they've developed in the plan they're trying to execute on. So for us, really, this is the foundation of good investment. Any good investment plan is making sure that we have a handle on this emotion, this investor behavior story. Otherwise, again, it just derails the whole thing. So that for us is a key concept. What I'll touch on, I'll just hit the highlights here. I'll just talk about a couple things. I'll talk about the two extreme emotions, what we call envy, and we'll also talk about loss on the other end. They say within behavioral finance that losses feel twice as bad as gains feel good. So I think we all can relate to that these days. But we'll talk about what that means, and then we have some ideas at the end to build in some of that discipline. But let's talk about envy a little bit. And this is a non-financial study that they did that really deals with that envy dynamic. You think about it, us as humans, we should only regret bad decisions, but too often we regret what could have been. So we regret a better outcome that somebody else had, even though our outcome might have not been bad, right? And they do this around the Olympics, around medal winners. Believe it or not, somebody actually studies this. But they actually look at the happiness of each medal winner on the podium. And they noticed that the gold medal, of course, is the happiest. We eliminated that obvious reality. But then they looked at the bronze and the silver medalists, and they noticed the bronze medalist is almost twice as happy as the silver medalist. And this happens every time the Olympic comes around. It's very consistent over time. And I think we can all figure out why, right? The bronze medal winner is just happy to have medaled, right? There's no prize for fourth place in the Olympics, right? No medal, no podium for fourth place. So the bronze medal winner is just happy they medaled, happy they got up on the podium. Silver medalist has some regret because they probably just missed out on the gold, right? They don't have that same feeling that the bronze medal winner had of just being happy to be on the stage. They might have some regret that they just missed out on the ultimate prize, that gold medal. So you think about this reality that we often regret what could have been a better outcome, or the millennials call it the fear of missing out, right? The FOMO, fear of missing out. And think about this with your investing portfolio. It happens all the time in investing, right? There's always a better investment choice or some other option that might have got you a little bit more return. And so we see this regret all the time with your portfolio. And this is a chart that we use that just looks at the last two bear and bull markets, not counting the current one, looking at tech bubble bursting, financial crisis, and you just lose money in a difficult market, right? Like, and we're experiencing that today. You can see tech bubble bursting, you lost about 18% in a portfolio that was 60% stocks, 40% bonds, and you lost 40% in the overall market during that period. Then coming out, you don't make as much. Specifically, look at that 11-year period from 2009 to 2019. S&P up 351%, diversified portfolio up 191. You trailed by 160%, essentially. Right? So that doesn't feel as good either, because you feel like, well, maybe I left too much money on the table. Is this still the right portfolio? We had all those type of questions. But the reality is, when you look at it and add up all these periods together, the diversified portfolio actually won, even though it never felt that way. You left 160% of the bull market upside on the table. You still lost money in a difficult market like we're going through today. But if you actually add up these entire periods, diversification won, even though it didn't feel that way. And I always joke with clients, you have a really well-diversified portfolio if it never feels good. Because you get this dynamic of regret at every level, right? You regret that you invested when the market's down, right? And you're losing 24% in 2008, one of the worst periods ever for a 60-40 portfolio. And then you probably have some regret when the market's up a lot more than your diversified mix. So for us, this is just a great example that diversified portfolio is always that silver medalist in this case throughout time. And we just need to understand that an emotional dynamic of a diversified mix. And the fact that you can actually lose more in those, if you lose less in those difficult periods, whether it's tech bubble, financial crisis, or the current virus crisis, you can win more by losing less if you do a better job in those downturns. You don't need to squeeze every last nickel, dime, quarter out of the bull market upside. For us, that win more by losing less story is a critical reminder at this point of the cycle why we build portfolios the way we do, right? You don't need all the upside. Just get a chunk of the upside. Do a better job in the difficult market. That has a bigger impact on your outcome. So for us, just a key reminder, and it's really all about that regret and envy emotion, right? It's every level of this. It's just tough to connect the dots, and it's especially when we always kind of live through some of these periods of time, and our emotions are often revved up and heightened at different points. Obviously right now that loss emotion's revved up, but I think this chart works in both markets to really remind us why we build portfolios the way we do. And this chart works because of the math. And they probably tell you never to do math on a conference call, but we'll try it here. Hopefully you can see the screen, and on the top left, this is all about the math of investing. And if you start with $1 and you lose half or 50%, you're down to 50 cents. So what do you have to be up the next year just to get back to break even? You can see you need to be up 100% just to get back to break even. And the interesting thing about this math is, look at the bottom of the chart in my fancy animation here. Look what happens if you're only down 10. You only have to be up 11% to get back to break even. And the deeper you get into this loss territory, the more the math works against you here. Right? You get down to 40%, you got to be up 67. There's our minus 50 up 100. Look at minus 60, right? Just an additional 10% loss for minus 50. But you have to be up 150% just to get back to break even. This is what we're trying to maximize in the previous chart, right? If we can limit the losses in those difficult periods, we can really find the sweet spot here, right? Where you're getting a chunk of the upside, but minimize the downside so that this math doesn't bend against us. It's really critical. I think one of the things, I think we all probably knew it at some point, right, from school or when we were learning about investing, but we just lose sight of this reality too often over time. And this is why that win more by losing less story can play out. So let's switch gears a little bit and talk about that loss emotion. I mentioned that losses feel twice as bad as gains feel good. It's kind of an old adage in in the academic world for that loss emotion. And often the loss emotion can really make us take action, or even that a lot of fear and anxiety around loss can make us take action. And this is another famous study that's done that's non-financial, market related, all about soccer, or I guess they call it football in Europe. And it's all about the penalty kick. Do we know what the penalty kick is? It's where it's just the goalie and the kicker one-on-one. And the goalie has no chance here, right? They're separated by about 12 yards. And the question is, what's the best thing for the goalie to do? Because they don't have time to react. If they try to react, the ball will be past them, right? The goal, I think, is 14 yards wide, something crazy like that. And the challenge here is often these penalty kicks will decide the match, and often decides the World Cups as well. So crazy amount of anxiety and emotion around what the goalie does. And they've done studies to say, what is the best thing for the goalie to do? And what they found was the goalie actually jumps left or right 94% of the time, because the last thing they want to do is not take any action. And that's what we see so often when this loss emotion gets revved up, is there's a natural inclination for us as humans to take action, right? If we think anything's broken, normally you have to take some kind of action to actually provide value and get something fixed. And so that's why the goalie, the last thing they want to do is look like they choke or froze and let their teammates down, let down their fan base. So they jump left or right 94% of the time. They found in these studies the best place to kick the ball is high center, because the goalie's never going to be there. So for us, this was an interesting study, because think how this relates to investing. If your loss emotion gets revved up, it's very natural for us to want to take action with our portfolio. But as we talked about a little bit earlier, that's often the worst thing that you can do from an investing standpoint, right? The worst thing you can do is maybe take action with your portfolio and take it out of the market following one of those worst days. And here's a famous study that every financial firm has in the industry, looking at the last 20 years. If you just would have stayed invested the whole time, 100,000 grew to about 324,000. But if you miss the best days, look what happens to your overall outcome, right? Completely disappears with just the best 25 days over the last 20 years. And I can tell you there's about 250 trading days in the year. So there's a little bit more than 5,000 years, or excuse me, 5,000 days over this stretch. So if you miss just roughly a month of these best days, look what happens to your overall outcome. And again, think about missing some of those best days. A little bit what we touched on earlier. Those best days and worst days are really clustered together, and that has to have a big impact on your outcome. So it's really that time in the market, which we've always heard about investing, right? It's not timing the market; it's time in the market that's critical. These best and worst days clustered together. If you move out following some of the worst, you'll miss those best. Here, of course, the famous quote from Warren Buffett, and it's probably the toughest thing to do, I think, in investing, is be fearful when others are greedy and greedy when others are fearful. Obviously, that second part, especially when that loss emotion's revved up, really difficult to do. But let's talk about some things that we can do to build in some discipline. And I think one of the things we don't touch on enough within the industry is that you need a check and balance. You need somebody to be that emotional check and balance for your portfolio. And I think clearly that's what your advisor, Doug and team, are there for. We actually at BlackRock, even for our portfolio managers and our best investors in the firm, they actually, within our risk group, they actually each have a behavioral coach that helps them with some of their natural traps and things that they tend to fall into as they manage money. So this is something that we're big believers in. Use your team, Doug and team, to really get that done, because these emotions can be tough. It's along the roller coaster. Every firm has this chart too. One of the best practices that we've seen over time is just to have a plan in place and talk about what you'll do if the market goes down another 10, 20%, right? And don't just do that during periods where the market's volatile or down a bunch like today. Do it at every point of the cycle, every meeting you have. What are you going to do if the market's down 10, 20, 30%, right? Are you going to rebalance? You're going to try to put more money to work, right? What's the plan to actually have that in place? And what we've heard from folks across the country is that it's a great way to reflect on conversations and a plan when your loss emotion isn't revved up. That really helps build in some of that discipline. You can reflect and say, hey, remember we said this is what we're going to do. We're going to rebalance if the market was down about 20%, at least a partial rebalance, and get some money back into stocks so we can get a little bit of that downturn rebound off the lows. And we just think that's one of the best practices that we've seen. The other big thing, and I probably can't highlight this enough today, is that the access to information is unprecedented. And you'll notice if you really scrutinize some of the headlines, whether it's the TV or the internet or even the newspapers, all the headlines these days are drawn to get eyeballs and viewership and rating. And they try to rev up that loss emotion that we all have, and they try to play on that. And it's just one of the biggest challenges we've seen to investing discipline is that all the information that we have on a regular basis is just bombarding us like never before. And they're all going for ratings. And one of the shows, and I'm guilty of watching these shows, on the CNBC News, financial news channel, the biggest financial news channel on cable TV, CNBC, their afternoon shows are called Mad Money and Fast Money. So think about that. They're not even hiding the fact that they're trying to play on our emotions a little bit here. But it's a natural reality of today's world. You got to be careful that you just understand that a lot of these are designed to play on our emotions to get that viewership and those ratings up. And one thing that they always do, especially during periods of crisis like this, they try to have everybody break out their crystal ball and exactly pinpoint when the bottom of the market will be, or how much the market will be going forward, or when this all end. And one of my favorite philosophers, Yogi Berra, once said, it's to make predictions, especially about the future. So don't get caught up in anybody on TV or any dramatic prediction you can see, because we had this study that looked at how good the Wall Street analysts are at predicting the direction of interest rates. So this is just the 10-year U.S. Treasury bond year-over-year prediction. You can see that they get it right a little bit less than the coin. The coin is a solid 50% consistently over time. They get it right a little bit less, about 43%. And that's just the direction of interest rates, not even the amount. But just a reminder that don't get caught up in some of these predictions. It just tends to harm your discipline in the long term. So hopefully that was helpful. I'm out of charts, believe it or not. Again, remember how important getting a handle on your emotions and making sure your investor behavior is in line. Otherwise, everything else doesn't matter. And it's all because of the way we're programmed as humans. You know, the envy emotion that we touched on earlier, with really that regret and envy is natural, right? The loss emotion as well, that time versus timing in the market. Remember that losses feel twice as bad as gains feel good. I think we can all relate to that. And then work with your advisor and allow them to be that check and balance on your emotion. We all need that. And most importantly, be critical when times are good, and when possible in periods like this, be opportunistic, even when times seem bad. I know that's difficult to do, but I think we saw some of those examples earlier with history, that history will probably look fondly on folks who do rebalance in a bear market, who do invest a little bit more and able to put money to work. I think clearly that's something that history's taught us, and most importantly, you know, save your emotions for the other things that matter in life. This one probably is more true than ever. This slide is more of the awe slide when I do it in person. I'll assume everybody's awing, but I think this probably hits more home today, given that everything we're going through than ever. So why don't I stop there? Hopefully that, again, was helpful. Some of the early stats, again, remember those volatility, those days surround each other. Lean on history as much as possible, those days, months, and 3 months period. Yeah, I think history looks fondly, not every period, but history looks fondly generally. And make sure our investor behavior and emotions are in check, and lean on Doug and team to really help get that done.
All right, thanks, Mark. And good evening, everyone. It's Nate Hanft here with you, for those of you that are calling in and can't see me. Mark, again, we just appreciate you taking the time to walk us through the presentation this evening. It is our hope that the information that we went over tonight adds some perspective and maybe even gives you a little reassurance as we continue through these uncertain days. Real quick before I pass things over to Andy to actually wrap us up tonight, I do want to mention something that I mentioned on Saturday. Mark actually set me up pretty well for this, but that is to say that it is very likely here in the near future that we will be rebalancing some of your accounts. Now, this is not going to affect everybody on the call, and just to emphasize, this is not a change in strategy. We are simply addressing some of the differing performance of the individual investments in your portfolio, because we want to make sure at the end of the day that we are maintaining the original integrity of your strategy. So as we do that, additional communication will go out, and certainly, just like anything you get from us, if you have questions or if you want to talk through it, don't hesitate to reach out. So with that, Andy, I'm going to pass things over to you. Let you close us out.
All right. Thanks, everybody. Thanks to Mark. Thanks for Doug and Nate. And thank you for everybody that has joined us tonight. You know, we continue to try to reinforce what we have communicated to you from the beginning, what we believe. Probably between the three of us, I'm the old guy, but I think we've got easily 50 years of experience together combined, probably even more than that. And we've seen this movie before as it relates to investments. I appreciate what Mark said there. You know, it may not repeat as Mark Twain said, but it sure seems to rhyme. And I think that's great. So I just want to say that we're going to continue to do this. I've forwarded information to various people, especially with some of the stay-at-home stuff in my other hat and questions that people have had. And if we send you something and you already know it, well, forgive us. But we're thinking that information is power. As you can think through things mentally, as you can reason with things in a time that's hard. That there's a lot of unreason, a lot of unease, and understand. I appreciate what Mark said. You know, the only way the Weather Channel gets you to come back is to say there's a big storm out there, and you know, sadly, I think that's what's happening with some of our news as well. It's good to get information, but we try to be the filter for you to say, okay, what does this mean? Brad McMillan has a great video that I think some of us have shared, and he's an economist that works with us at Commonwealth. We'll probably be sharing some of his written and maybe a video in the future. But we're just here to help you through it. You know, I've had people over the years that said, gee, I didn't sleep well last night. And they call me the next day, and within 5 minutes, they're like, wow, you're right. I kind of forgot about that, or I know we addressed that. So as I said the other day, we've been accused typically of being too conservative. But I think Mark laid out why that makes sense, why a blended portfolio will never feel really good. And that's probably just the right mix when you do it that way. The key in the end is that we want to do something that works for you. And so that's going to be our goal. And to do that, you've got to communicate with us. Yes, we're working electronically, we're working some distance, but that doesn't mean we're not available to you at any time with any questions. We really appreciate the partnership with BlackRock. I mean, they are the largest money manager in the world. So to have somebody from their company talking to us, to me, is very powerful. So no, we didn't open this up for questions tonight. We're impressed how well the technology worked tonight, and thank Mark again for that. So we're going to say to you, if you have questions, email us. If you have that Investor 360, use that. If a phone call is going to work better for you, great. We're here. We're once again we feel blessed that you've chosen to work with us. We take this very serious, and it's these times where, you know, we want you to have comfort, at least, that you have a thoughtful process that works for you. And if there's any concerns or question, let's try to have a conversation and work that out for you. So thanks again to Doug and Nate for their work of putting this together. Thank you to BlackRock and Mark and his team. And we will be in touch. We'll probably do this again. That might be good feedback. If you thought this was helpful, if there's some other topic or issue that you might be interested, please let us know. Some of the federal packages that's coming down, we might have some information on that in the future, because that does affect required minimum distributions and some other things for you. And that will be a topic for another day. So anyhow, have a great evening. Thanks again. And we really, really appreciate your time with us tonight. And be well. Keep that perspective, as Mark said. We are a blessed nation, and we believe that our faith carries us through difficult times, and it's why we want to serve you and make sure you're as comfortable as can be. Thanks again. Have a great evening.
Thanks, everybody. Thanks, Doug, Nate, Andy.